Men are from Mars, women are from Venus. Harris is bullish for bonds, and Trump is bullish for stocks. One of the most surprising economic developments over the past year is an acceleration in U.S. labor productivity growth. What is driving it? Is it sustainable? What does it mean for the Federal Reserve's interest rate policy in the U.S. dollar? The fixed income market is making a strong comeback in 2024. Inflows into long-term bond mutual funds and ETFs are at their strongest in 3 years. With a sharp decline in bond yields over the past 2 months, and with the Federal Reserve set to cut interest rates in less than 2 weeks, everyone seems to want to get in on the action. Of course, the million-dollar question is how much juice is still left in the bond rally, with the market having already priced in 250 basis points worth of rate cuts by the end of 2025. History says that 250 basis points is nothing for a Fed easing cycle when the US economy goes into a recession. The key word here, of course, is recession. History says that when the Fed cuts rates outside a recession, the moves tend to be much smaller. A good example is 1995, which we will speak more about later. In any event, whether bonds are cheap or expensive depends on the likelihood of a recession in the foreseeable future. If you think the US is going to enter a recession sometime over the next year, then treasuries are very cheap. If you think the US will avoid a recession, then treasuries are expensive. I see many risks and headwinds, but a US recession is not my central scenario right now. Well, not yet anyway. I argued a few weeks ago that a necessary condition for a recession is a slowdown in corporate profit growth. The recently released data for the second quarter shows that, if anything, US corporate earnings growth is picking up. Over the past 60 years, there was not a single US recession that wasn't preceded by a decline in corporate profit margin. Notwithstanding high borrowing costs and a tight labor market, the US non-financial corporate sector continues to defy odds by clinging onto its post-pandemic near record high profit margin. To get a recession, we need tight financial conditions. Yet financial conditions are easier now than it was when the Fed started hiking interest rates in 2022. To get a recession, we need tight credit conditions. Yet credit conditions have been easing over the past year. There are concerns about US consumers being stretched, about rising credit card debt and falling saving rates. This may be the case for some consumers, but the aggregate household debt service to disposable income ratio is no higher now than at any time over the past 10 years. These are all reasons why the Fed does not seem too concerned about the recent signs of slowdown. They are also why Wall Street forecasters to see only a 30% chance of a recession over the next 12 months. Wall Street does not have a great track record of predicting recessions, but I think 30% is fair, given what we know today. To me, 30% embodies the risk of a direct conflict between Israel and Iran, and the risk of a major correction of AI-related stocks. As much as I think the AI bubble has burst, the valuation of AI beneficiaries like NVIDIA and Microsoft is high, but not crazy, like is the case with Tesla. NVIDIA is trading at 26 times of its 2025 estimated earnings, in line with the likes of Microsoft and Amazon. I will change my mind if the data changes, but I am not yet in the recession camp. This is why I see little value in the front end of the US yield curve. 2-year treasuries at 3.75% look expensive to me. So let's assume for now that the US is not going into a recession. Let's assume that all we get is a mid-cycle slowdown, sometime over the next 12 months. Is there value in long-term bonds? This question has to do with the level of the so-called R star, the neutral real Fed funds rate, with monetary policies neither expansionary or contractionary at full employment. The 5-year real yields 5 years forward, which is a good proxy of R star, is currently trading at 1.66%. Despite the dip over the past year, at 1.66%, it is still higher than almost at any time since the Great Recession of 2008-2009. With inflation showing clear signs of moderation, is our star too high? There are no more important questions for bond investors right now. Our star is highly correlated with trend GDP growth. Trend GDP growth has two main drivers: productivity growth and population growth. One of the most surprising developments of the US economy over the past year has been a reacceleration in labor productivity growth. The reason why it is surprising is because in past cycles, labor productivity growth tended to slow as business cycle expansion matured, as the pool of available workers declined. So what's different about this cycle? It is tempting to attribute the surge in US labor productivity growth to the adoption of generative AI, but direct evidence of this is scant. If you would allow me, I'm going to give you my speculation. Let's begin by considering labor productivity at the firm level. In theory, we should expect a company that manages to raise productivity of its workers to be rewarded with an increase in its profits, or else being equal, of course. Given the Magnificent Seven have contributed most of the acceleration in US corporate profit growth over the past year, I'm inclined to assume that the surge in labor productivity growth that we observe at the economy level is due to what happened at these companies. I think part of the story is that these companies are in a unique position to use Gen AI as a productivity enhancing tool. The fact that most of these companies, despite record revenue and profits, continue to engage in layoffs in the name of streamlining their workforce supports my supposition. Another part of the story that I suspect is even more important is that generative AI has further accelerated the migration of corporations to cloud computing. Cloud computing allows companies to rent their IT instead of buying it. It is a way for companies to outsource their IT departments to cloud vendors like Amazon, Microsoft, and Google. There are many advantages to cloud computing. It makes data and software easy to access from anywhere. It centralizes security. It speeds up implementation of new applications. It allows companies to reduce downtime and access always the most updated versions of their platform software and data. Cloud computing offers companies an instant boost to their productivity. Generative AI has made the adoption even more compelling, not least because AI automates the complex migration process, minimizing errors and optimizing resource allocation. As more and more companies migrate to the cloud vendors are raking in the profits. The cloud business has low marginal cost. Moreover, given there are only a handful of big cloud vendors, they have tremendous pricing power. I suspect that productivity gains associated with the adoption of cloud computing is more likely to accrue to their bottom line than to that of their customers. In this respect, we can view the huge investments that these companies are making in expensive NVIDIA chips as trying to keep out competition so that they can retain their pricing power. It is difficult to see this ending anytime soon. The global cloud market, estimated to hit $700 billion in 2024, is forecasted to grow by 15 to 20% every year for the next 5 years. If this is correct, the recent acceleration in labor productivity growth may be here to stay. This would imply a higher R star. This is why I think where the Magnificent Seven go, US rates and the US dollar will follow. Trend growth is also a function of population growth. Birth rate in the US is falling. US fertility rate dropped last year to the lowest level in a century. This does not bode well for long-term population growth and GDP growth. However, the Biden-Harris administration let in 10 million illegals into the US in the space of less than 4 years. As I argued in another video, even if Trump is to get reelected, deporting 1 million people, let alone 10 million people, will be an extremely difficult enterprise. Considering US labor force grew only 2.5 million in 2024, 10 million illegals are more than economically meaningful if they all end up staying on in the US and enter the labor market. Recent immigrants are more likely to be of working age than US nationals. According to calculations done by the Wall Street Journal, 68% of recent immigrants aged 16 or older are either working or looking for a job, compared with just 62% for US-born Americans. For many reasons, the labor participation rate of recent immigrants is very likely to climb further in 2025 and beyond. All else being equal, this should help support GDP growth and R-star, the neutral real Fed funds rate. That said, it is less clear what this means for nominal Fed funds rate in the short term, given the increase in labor supply is loosening labor market conditions and weighing on wage growth of Americans. The US election is only 2 months away. It has huge implications for the level and the outlook for R-star. I've said in a previous video that given the massive US budget deficit and debt, when it comes to US fiscal policy, it probably won't make too much difference whether it will be Trump or Harris in the White House in January. Both would face serious fiscal constraints. What this means is that the direction of R-star will come down to which of the two candidates can move the needle more when it comes to supporting productivity growth in the animal spirit. Here I'm going to give the benefit of doubt to Trump. During his first term, Trump removed red tapes and deregulated aggressively. He's promising to do more and has already adopted Elon Musk's proposal to create a government efficiency commission. If the US government is as productive and innovative as the Magnificent Seven, then there is no stopping the US. This is the most exciting news that I've heard in this election year so far. This and the fact that I continue to think that Trump will win in November make me wary of chasing the current bond rally. Thank you for listening.